What's up guys, welcome back to InvestingPH. Today we will evaluate a very well-known high dividend paying stock and another power company, which is SPC Power Corporation. Let's see how it does in our checklist. With that said, let's start. Before we start, would really appreciate it if you would click the like button, and if you haven't yet, please do subscribe to my channel. Now, if you have watched my previous stock analysis videos about power companies, what I really want to see when evaluating companies in this industry is, are they taking that step to transition into a more renewable energy approach? Although transitioning to a renewable energy approach is more costly and less efficient compared to conventional energy production. Our world right now really needs a breather from this kind of pollutions. If you aren't aware yet, temperatures are rising right now because of the rising greenhouse gases in our atmosphere, and 25% of all greenhouse gas emissions are produced by electricity production, which is the second largest contributor. So let's see if SPC takes up this challenge to transition to a more cleaner approach in producing energy. Now, who is SPC Corporation? Incorporated in the Republic of the Philippines and registered with the Philippine Securities and Exchange Commission on March 11, 1994. SPC Power Corporation, together with its subsidiaries, generates and distributes electricity in the Philippines. The company operates through generation and distribution segments. On April 2, 2002, common shares were listed in the Philippine Stock Exchange. Now, SPC really made it hard for us investors to see each of their power businesses. You really need to research this one by one. Really hate it when the company's website doesn't show clearly each of their businesses. It leaves me that feeling, how can I invest properly in this company if I don't know what I'm investing in? Their home website doesn't even work. You see that? Anyway, their first subsidiary, SPC Island Power Corporation, SIPC, operates the 146.5 megawatts Panay diesel power plant and the 22 megawatts Bohol diesel power plant. Also owns and operates the Olango diesel power plant, which supplies all the generated electricity to Mactan Electric Company Incorporated, an associate. Second, Cebu Naga Power Corporation, CNPC, incorporated on August 12, 2015 to undertake the development, ownership, construction, operation, and management of the new 150 megawatts CFBC coal-fired power plant to be built in the province of Cebu, but as of December 31, 2017, further development for the construction of the new power plant has been temporarily suspended. Third, SPC Malaya Power Corporation or SMPC. SMPC participates in the annual bidding for the OMSC of the 650 megawatts Malaya Thermal Power Plant located in Pililia, Rizal. Fourth, Bohol Light Company Incorporated or BLCI was organized on July 21, 2000 to engage in the business of supply and distribution of electricity subject to applicable laws, rules, and regulations. Fifth, SPC Light Company Incorporated and SPC Electric Company Incorporated, primarily to design, construct, install, commission, rehabilitate, maintain, management, operate, and invest in power generation distribution plants and related facilities. They also have the following associates: KEPCO SPC Power Corporation, primarily to build, operate, maintain, own, and manage the two 100 megawatt circulating fluidized bed combustion CFBC boiler coal-fired power plant in Naga, Cebu. Second, Mactan Electric Company Incorporated. This conduct and carry on the business of generating, buying, and selling electric light for sale within the limits of the city of Lapu-Lapu and municipality of Cordoba in the province of Cebu. With all that said, this is their overall power plants which has government approvals. This is from their 2020 annual report, so we can see all of their plants are coal and diesel-fired power plant. Now for their future prospects or future projects, they are looking into hydro plant projects since their Naga power plant, which is another coal-fired power plant, was halted by the Supreme Court. Don't know when will that happen. Now a lot ask me why I don't invest in SPC since I'm a dividend investor as well. As you see, I really don't want to support power companies that doesn't even have any renewable energy and still doesn't have any future renewable energy project that is ongoing as of the moment. Even though they have a good dividends for me, this is one of the reasons why I didn't invest in this company. I want the companies I invest in to have ideals that is in line with mine. Going on to their financials, we would still be following our checklist when valuating this company. Do watch my other stock analysis videos to further understand every line in my checklist. First, we look at their income statement. If we look at the revenue line, we can see it doesn't have quite a good growth rate, fluctuating in different years. Now, 2020 and 2019 growth is really expected to be negative. Almost all power companies are the same for these years because of the pandemic. Their 10-year revenue growth rate is only 5.33%. Now, for their net income, almost the same, but much better in overall terms of averages. This is also because their net income margin is increasing year after year, which is a great sign for a company. This means every year, they are producing net profit from their revenue more efficiently. Now, mostly what I want to see is from the 5-year averages up to the 10-year average, at least it is hovering near 10% and better above it. But still, this is a check for me because if we compare it to their other competitors, SPC is fairly better in terms of growth averages. But there's a catch here, guys. Now, I want to show you the differences in their net income margin. If you notice, SPC has a really high net income margin compared to AP and FGen. If you notice, FGen has the lowest. But one thing about FGen has a pure renewable energy. Aboitiz has about 26% renewable energy portfolio. ASEN also has the same margin as AP since their portfolio is still a mix as well, about 50% plus in renewables, while SPC has 100% non-renewable source. So you have to take note of this when comparing these companies because like I said a while ago, renewable energy production is more costly and less efficient compared to non-renewable approach. This is why SPC still has the highest net income margin because of its 100% non-renewable source. So this is the note for this one, although it's still a check since even with 2019 and 2020 was greatly affected by the pandemic, their income statement still did fairly better for a power company. Next, we go to their balance sheet. Now with this one, we can see their equity averages are great, but what I don't like here is look, ever since 2016, their equity growth started slowing down. Again, there's no pandemic in these years. We can exempt 2019 and 2020 because of the pandemic. But what happened to 2016 onwards? Although their 10-year average has 11.87 growth rate, this is only pulled by their 2011 to 2015 growth. Now I want to show you guys the growth of their competitors to see why this is not a check for me. AP continued its 10% growth except again for 2019 and 2020. FGen the same, but much stronger in terms of growth. You can see they have continued growing yearly. Meanwhile, for SPC, started strong, but as years goes by, its growth was decreasing. This isn't a good sign for me. And remember, SPC is still quite small compared to FGen and AP, which has a market cap of 100 billion. How come these already big companies maintain their 10% growth in 2016 onwards? That's why it's an X for my list because this isn't a good sign for me. I hope SPC would recover the speed of their equity growth in the upcoming years. This way, our valuation of it would change. Next is their ROE growth. So what we want here is for their 5-year return on equity average to be above 15%. With this, SPC has a 5-year average of 17.64. This is a check for us. These are the ROE of its competitors as well. AP 14.50% ROE and FGen 9.10%. Again, never look at ratios blindly. ROE can be influenced by a lot of debt. We go to our next checklist, which is the debt to equity ratio. With this, they really have a very low debt to equity. This confirms their ROE growth isn't influenced by a lot of debt. This is our guidelines for this ratio. With this, it's a check for me. So these are the ratios of their competitors as well. We can see all of them pass our guidelines. Next, we go to their free cash flow. We can see their free cash flow kind of fluctuates yearly, but always in the positive line. FCF again is computed by cash from operations minus capital expenditures. Their averages are also good. With this is a check for me. Now let's check if they can pay their long-term debt using their free cash on hand in just under 3 years. We can see they don't have any long-term debt at all. With this, another check for us. Next, let's look if they are handling well their short-term obligations or their short-term debt well. This is the current ratio. With this, we get a current ratio of 9.71, really high. This means they have 9.71 peso of current assets for every 1 peso of current liabilities. Great, right? No. Now again, never look at ratios blindly. It doesn't mean they have a high current ratio, it's an instant check. That's why what I want is for their current ratio to be at least between 1 and 2. Now let's look at the story. Their equity growth has really slowed down in growth ever since 2016. That's why you have to know the story. Too high of a current ratio may indicate they aren't efficiently putting their current assets to good use to grow the company. They need to use more capital to grow more the company since they have a really high ratio for this. I could have checked this if I can see their equity has been in consistent growth, but as we've seen a while ago, their growth rate has really slowed down. You can see the connection. Ever since 2016, their current ratio started rising, same as the slow growth in their equity. Now, these are their competitors' current ratios. Next is their PE ratio. They have a PE of 12.17, meaning you are paying 12.17 peso to earn 1 peso. This is a check for us since what we want here is for this to be below 15. Next, does the company pay out dividends? Well, SPC is really a good dividend payer, consistently giving out high dividends. Right now, even though its price has rise up, it still has a dividend yield of 7.79%. This is a huge check for us. Next is the company's MOAT. What makes this company sturdy against its competitors? Now, just like what I said, let's repeat. What makes this company sturdy against its competitors? Although SPC has a well-handled short-term and long-term debt, they are quite lacking in net income and equity growth to consider it to have a good financial moat. Next, they are really lagging behind in new projects against its competitors, and they still haven't yet put a single renewable energy in their portfolio. This really is seen in their slowing equity growth. Although they have announced they are planning to put RE in their portfolio, that is still a plan. Meanwhile, FGen, AP, ASEN is already doing it, not just planning about it. So this is really an X for me. For me, I can find a huge competitive advantage for them against their competitors, which is rolling out project after project yearly. They may have started strong in growth from 2011 to 2016, but they are really lagging behind now. Next is their company governed by a good leader. Their chairman is Alfredo L. Heinares and their CEO, Dennis T. Villarreal. Both of them have handled a lot of companies, more or less companies connected to SPC. Now I want to check this since they really have a lot of experience, wherein that's what I look at, but their slow transition to renewable energy and project rollouts makes me doubt their leadership. And what strikes me the most in their annual report, their chairman only have one share in the company. Actually, most of their directors don't hold a lot of shares except for the CEO. Now, most companies I evaluated, their directors have a lot of shares in the company. They invest in their own company. For me, this is simple logic. Why would I invest in a company where the highest position holders in the company doesn't even invest in the company they handle? This is my thought about that, okay? Anyway, these two have handled SPC for a long time, but their slow projects as of now and still clinging to the old ways of energy production while its competitors are now transforming their energy portfolio to a much cleaner approach gives them a half check in my list, 0.5 points. Lastly, is it within our buy below price? My computed intrinsic value for SPC is 12.9. With a 30% margin of safety, I have a buy below price of 9.03. Right now, its price is 12.84, so this is an X for my list. So SPC scored 7.5 out of 12. Now I really hope SPC would get back on track on its growth and invest in renewable energy in the future. And maybe I would invest in this company. Their dividends are really great indeed. Anyway, I hope you guys got a lot of info from this. And if I missed out on some things, do comment down below. Would really appreciate it. Again, if you haven't yet liked this video, do so right now. And also, if you haven't yet subscribed to my channel, click that subscribe button now. Thank you and see you in my next videos.